Good morning, everybody. I'm Dalton Chavis. This is going to be my final project for the final for this class. For my slides, I chose Dole PLC, the produce company. Most people know them for pineapples or bananas. A little backstory: I chose Dole because I work in produce at Harris Teeter, and a little thing I like to do is I look at different companies that send us stuff and that we buy and purchase from, and I considering to myself about how much money do these people make around the world or to other companies. Alright, but let's dive into this thing. Starting with Dole, the company. Dole PLC stock sits at 12.31. This was for May 24th when we started. But as a whole, Dole PLC, it starts at January 2021 because of it was originally Dole Food Company before 2021, but after the pandemic hit, they merged with Total Produce PLC, and then together to get through the pandemic, they merged, which made a better whole company. So in July 2021 to the present, Dole PLC is the new produce company with both of them merged. This is the board of directors. Carl McCann as the executive chairman, Johan Linden as the operating officer, Roy Bryan and Jacinta Devine, one of those. Most of these people stayed from Total Produce. One, I believe, stayed from the operating officer stayed from Dole, just because I guess they wanted to stick with it, and or they had better reputation. But the countries of operation for Dole PLC, they're an Irish-American agriculture multinational corporation. They're headquartered in Dublin, Ireland. It's pretty far away. As one of the largest producers of fruit and vegetables, Dole operates in 30 countries and supplies approximately 300 products across 75 countries. This is the different types of places around the world they ship to. Their primary business is of marketing fresh fruit and vegetables through the world, mostly in North and South America, a little bit in Europe and Africa, a little bit of the rest of the world. They're mostly known for pineapples and bananas, but they also do other soft fruit vegetables as well as juices, fruit cups, random stuff like that. Like even stuff that don't even belong in the produce area. They have some stuff that gets stocked on a shelf in the store. The biggest competitor, in my eyes, the biggest competitor is Fresh Del Monte. That's who I've seen mostly of. We purchase from Del Monte as well as Dole for us around in Fuquay, North Carolina, Bondwell, and then Green Yard Produce. You also have other people. They're not exactly produce oriented, but like Green Giant, that's a good one. For the Dole's calculated ratios and Fresh Del Monte's calculations, these are tricky. I'll probably mess one or two up, but we'll get through them. I didn't put down the numbers for Del Monte just because I think I was just doing it quick one night. Well, we'll go through it and I'll talk about the different type of ratios. A current ratio is the current assets divided by current liabilities. And I'm pretty sure I did this through, if we click on the first quarter financial results, the URL I have right there, it brings up to, I think it was either end of April or the beginning of May, about for 2024 this year. The current ratio, they have a 1.14. Del Monte has a 2.16, which is good. Current ratio is the primary liquid ratio. It's calculated by current asset divided by the current liabilities. That's assets are like cash, marketable securities, account receivable, inventories, Liabilities consist of accounts payable, accrued wages, taxes, short-term notes payable, which are expenses pretty much. Assets are good. Liabilities, you want minimum liabilities. And then for quick ratio, current assets subtract inventory divided by the current liabilities. They have a 1.14, which is good. The industry average is 2.2. Then you have inventory turnover. Inventory turnover, you divide sales by various assets, as in inventory. Sales divided by inventory. And the industry average is 10.9. As well as after that, you have day sales. Day sales, also called the average collection period, ACP. You divide accounts receivable by the average daily sales. And if you can't find the average daily sales, which same thing I had to do, you just divide the annual sales by 365, which will give you what each day was or will be. The average is 36. They have a 23. Anything past 33, like if you had 40, I would say it's not good. That means they're not paying their bills on time, essentially. Then we'll just go into fixed asset and total assets turnover. Fixed assets is sales divided by net fixed assets. The industry average is 2.8. They have a 1.4, which is a little under the average, which means they're not using their assets to what they could be using their assets for, what they should be. Then you have total assets turnover. Total asset turnover is sales divided by total assets. But this was they have a 0.43. This is for the first quarter of the year, so obviously it will get better, hopefully. And then Del Monte, they have a 2.14 or 2.16 current ratio. Quick ratio 1.05. If you compare them each, the inventory turnover rate is 6.4, and then the day sales 40. Fixed assets 1.31. Total assets 1.36. Now if we go into the balance sheet, the balance sheet shows asset, liabilities, and equity. Equities are good, assets good, liabilities bad, pretty much, essentially. And it shows all the other good, small, specific details within the balance sheet. I will go over the total assets, $4,507,000. Liabilities is $3,061,000 with a total equity of $1.412 million. Which, if you think about it, this was for March. Yeah, so the first quarter of March. They have plenty of assets they have accumulated over the year, especially with the two companies merging. Liabilities are pretty low considering how much assets they have, and it was two companies merged. Equity's good. It could be higher. Going into the income. The income is where it's at. The income sheet. Income, what makes a company. Revenue. Revenue is what everyone will look at first at a company that isn't going deep into their finances. They'll just say how much money they're making. Income sheet, we got the net income, $70,000 so far. Basic, $94,000 for the weighted average shares. We'll get into shares after in a little bit. They do have income per share. We'll also get into the income per dividend per employee later. The net income, $65,000 so far. Net income to Dole was $70,143. Okay. The income tax expense, people overlook that as well. How much people have to pay on taxes and bills. Very expensive. The statement of cash flow. This is Where did the money go? Where does the money come in? Where does it go out? Stockholder equity. This is a quick look. Okay, now the immediate applications of the ratios. There's different type of ratios you can look for in a company when you want to talk or analyze the company. Liquidity, asset, debt, profitability, and market value. What I got for an immediate application from Dole is with the liquidity. The company has the ability to pay off the debts that are maturing within a year, so they have the ability to make enough money and use their assets smartly to pay off the bills they have within a year, with their current ratio proving that. And then asset management is how well the firm is handling assets, what they're doing with the assets. Are they just letting them sit? Are they just going to fall off eventually? Are they resting, we can say? I believe Dole, they have a positive asset management, which could mean they're within the maturing year, they're using their assets effectively, but in the long run, they could be able to eventually run into some problems. Maybe. Depends on how it goes throughout the year. We'll see at the end of this maturing year how well they use their assets. Debt management is how well a firm has financed its assets and the firm's ability to repay long-term debt. Their debt management ratio is 1.02. It's above the average, and it represents Dole can be financed in a good manner. As in, if a loaner looks at this company, they're saying, okay, they'll be able to pay me on time and pay the interest with the principal. So they're trustworthy. They're profitable. The net results of the firm, financial policies, and operating decisions. Dole has a profit ratio of 46%, which can be considered above the average, but that could also mean that they're just getting profit, but they're not showing all of it, and or they're not showing all their expenses, and they're just making a lot of money. That could also just mean they're making a lot of money. Market value ratio relates to the stock price, their earnings, and book value price. They have a PE ratio of 6.3, which could be better, but it isn't the worst. That means the stock needs to be increased in price. It went down over the years. I mean, given life and what's been going on with the merge and through the pandemic, the stock fell a little bit than what it originally was. But stocks are unpredictable, as well as they have a promising future. They want to be sitting at a $17 per stock. They're at it's roughly a 12. It's feasible. They can do it. For the long term implications of Dole's analysis, a good rate from a firm is a 1.2 to 2. They have a 1.14. It's above a 1, so it's good, which means Dole has more assets than liabilities, which means they can clear debt quicker because they have more money sitting, more positive money sitting than they do negative. Liabilities could be considered negatives and expense. So if something happens, if you take the positive, subtract negative, what do you get? Asset management ratio. The average rate for an asset management is above 0.5. Those above that, which means they have a good hold on their ability to successfully use their asset to their advantage. They're using them well. They know what they got, and they're making sure they're not losing money off of what they already have. Their debt ratio is 0.3. Debt equity ratio of 1.02, which is above what it should be. So in theory, Dole has a decent plan to handle and pay off their debt. They're making the payments right now. They're not falling behind. They're using their assets smartly. It's only the first quarter of the year through these finances, so they're definitely doing the right thing. They're making money, and they're making sure their debt's paid, so they don't have nothing coming back on them. The average industry would be a 1.5% to a 2% would be a good hold on a profit. Those sitting at a 14% so far. as well as I put in which could mean that the company is rising and will be rising. If they're making that much money sitting at right now on profit, what will they be at the end of the year? Who knows? As long as they don't just fall off, which it can happen. Anything can happen in business. The revenue per employee is sitting at $245,000. That's a lot. Considered their revenue though, is a lot. Market value is a 6.38, which isn't low, but it could always be better. Any market value ratio, the higher percentage is better. That means the more money you make. They're sitting positive, but the company to network and open a new location is easy. Having a better market value could take the company to networking and open a new location is easy. Well, they're already out of 30 countries. Out of Dublin, coming to America, North America, South America. They're doing something right. Their peer ratio I did analysis was Fresh Del Monte. Their current ratio is 2.16. They can use their assets to get rid of liabilities within the maturing year. Their asset management ratio is a 6.49, which means their assets can be turned over and restocked by 6 times, which is really good. Debt management, Del Monte ratio of debt is 0.31, which is below average by the 0.05 with 36%. Their profit, Del Monte's EV/EBITDA is 17.47 and EV/CFC ratio of 9.62. Del Monte is positive when it comes to profitability. They make more money than they spend. Their market value, the return on equity is negative 1.2, which could be bad for the company as the company is making money, but the expense for salaries could catch up, with profits per employees being negative $625. So Del Monte try to catch up and have open new locations with a lot more employees for the starting year. With that, it comes you have to pay everyone that comes to work the salary they're paid and or hourly wage, however it is. But you have to pay them if they work. You have to pay. It's the law. And then you just have to make sure you're making enough money to pay the employees. The long-term implications of Del Monte is the assets could potentially save the company. That is can cover the liability if they have to scratch the firm bills, and if they keep going down in market value or overpaying employees or locations or equipment, whatever they have their expenses on, their assets could cover the bills. The assets are being managed very well in a profitable way to help the company potentially keep the company afloat for future accidents or business failures. Their debt ratio is showing that they are in debt, but they need to focus and get rid of the higher debts, and they could show future business partners or owners that the company could struggle paying off these debts with their debts right now. That's most businesses. They get loans or money from somewhere or debts, and they just pay it off, which isn't a bad thing. But some owners could see that as in they don't want to add another debt to them because they're not sure if they get their payment for their debt or loan they're trying to give. Their profit is positive, which means they're selling product, but they're buying and trying to make or grow, which can help a company grow and continue to operate continues for future operations. If you keep making money, you can continue to go, or you can just give up. It's whatever. Del Monte, they're making enough money to stay afloat, but with the stock and market ratio being low and the employee pay being low, it can mean they can fall out of business. They could lose business partners or future investors. They could fall from the network, and they could be left alone, stranded, which isn't a good thing. But being such a high-valued company, I don't think that would happen. The stock analysis for Dole. Their stock went down drastically since the merging of the two companies, but has been reset after a drop and now on a full recovery growth, planning to surpass the opening dollar amount. Their opening dollar amount was $14.40, and they're planning on sitting at $17. If they get to the sitting at $17, that will be above the opening amount, as well as a huge growth from what they are at the beginning of this year. The ratio analysis for their stock price. Their stock price will continue to grow as they are the leading fresh produce distributor around the world. The shares statistics show a decrease in shares and stock price overall, but shows a possible growth to market average for the maturing year. Dole will continue to grow unless they don't want to. They have went down. They have dropped below 12 before, but they have merged back up victorious. So they'll keep grinding because that's what they do. They want to get to the top. They don't want to just sit. They want to continue growing. The types of financial risks. There's many types of financial risks. We'll go over this and then I'll go over the other one. I would say Dole has a stock risk with it being fairly new, conjoined as Dole PLC since 2021. A lot of companies want a lot of longevity for their companies. They were sitting at, for as of June 16, they were at 1186, but they had started off at 1450 in 2021. They have hit a high of 1627 in 2020 at the end of 2021 as well. They had a 52-week price drop of negative 13%. That isn't good. And Dole wants a price target of $17, which will be an increase of 40% from 12 to 17, which is possible, but the risk will come with wanting a high market in stock. Investors and shareholders want to invest with the risky asset unless they are compensated with a high expected return. That being said, the dividends payout is 32 cents, which is 2.7% of the dividend. With the price target being so high, with the drop in 52-week price, it shows people would probably want to, with it being so low at $11 and $12, people will want to buy this stock. Being it so low, you want to buy it, so when it kind of goes up, if it goes up to 17 at the end of the year or whenever they want to hit this target, that's a 40% increase. So you want to buy now, and when it starts going up to that, or getting roughly around that 40% increase and it sits, that's when you want to sell. As in, you buy low, sell high for stocks. But the other types of financial risk, I mean, you want a risk return and then a trade-off. You like return, but you don't like risk. People who invest want to earn more money than they spend, and they don't want to feel iffy about it. So they don't want to be nervous or thinking, am I going to win or am I going to lose this? There's different type of risks involving specifically financial, but within a company you like legal risk, reputational, operational, credit. Then you have like market risk, currency risk, interest rate, financials, liquidity. Like you have a lot of different risks that come with a company, as well as just buying stock. Most people just buy stock because they just get on stocks and they see Tesla's $200, $300. I don't know how much it is. $170. Amazon's at $200. Oh, Microsoft's at $300. Then you get up to them expensive S&P 500 fortune companies, and they're up there. Short-term bond. Dole doesn't have any short-term bonds because they didn't offer that. I'm sure the companies before the merge probably did. I didn't dive that too deep into it because Dole PLC doesn't right now. So I found a similar company, B&G Foods. I try to stay in the produce area, so it's like a competitor, and I'll use them. Their bond it started in 2021. I would consider this a short term because it was 5 years. It's a 5 year. It ended 2025 or 2020. Yeah, the beginning of 2025. It's only 4 to 5 years, so I kept it short term. They also had a long term that was like 7 years. Short term is 3 to 5 years, I would say, for at least to get back the principal. A short term bond is an investment a company offers to investors that they can buy a bond and collect interest off the principal that they paid. Yeah. So the bond cost originally started at 102. It went down to 88 in 2022, which was a drop. That's not good. Then came up, started eating back up to the top, 98, and then got to 99. Payments per year were twice. The coupon was 5%. The yield was 6.9%. You want a higher yield, as in you don't want to spend. Let's say it started at $100. The issue price was $100. It had originally went up to 102. That showed, wow, people are making money off this. Maybe I should get more bonds, or we should give more. And then it dropped down to 88, which means not good. Also did the same company, B&G Foods, for the long term. Long term is just anything past 5. I would say 7 to 10 years. I don't think they go past 10 years. Started in 2020, ends in 2027, which is 7 years. The issue price were $100 for USD. The coupon was 5.25%, twice a year. The yield 7.8%. It started at $100. It had originally dropped to 95. Then it went up to 105 after being not even half a year. It went down to 103 in 2021. 2022 went to $77, which is a big drop. To 2023 it was at 90. At 2024 it was at 92. The maturity year is 2027, so they at least want to get back to the starting price at the minimum. For the stock evaluation, now we're back to Dole. The cost of preferred stock, the dividend by price. Dividend is 32 cents. The price was sitting at 12.24, so it's 0.026414%. It's a low payout. It seems like a low payout and a bad deal at first glance, but when you think about Dole as a whole, last year had a revenue of $8.38 billion. That's a lot of money. If they're on any track they were last year or previous years, they're going to make roughly the same, if not more money. So the dividend will just go up. They'll just increase the dividend a little bit to show investors we care about you and we're looking out for y'all as well, since you've been looking out for us. The return formulas for all being positive, such as the return on equity, return on assets, the return on IC, which is 14%, 4%, 6.86%, which are all positive, that's what you want. The cash flow being $231.55 million, and the capital ventures being $76 million. That shows the profit. That just showed the profit of the cash flow. I would recommend buying this stock because it's low at the moment, which is has a good history of numbers, and the company should flow towards the goal expected at 17 from the 12, which is a 40% increase. Anytime a stock is low, if it has potential, buy. Unless it doesn't have potential. If it's low cost-wise, but it's been low the entire lifespan of its career, don't buy. It's not going to grow unless it's expected to grow randomly. The overall summary of my recommendation. Overall, COVID-19 impacted this company as far as the stock and for the price drop in 2021-2022. But the merge of the companies probably kept both companies afloat very well. And then it probably halted the company for the shipments because COVID was the world epidemic that stopped outside travel and outside resources coming into, unless very thoroughly checked. They stay strong because they had strong tactics and a strong background with strong leaders. Strong leaders make a strong company. With strong employees make a strong company. This is a buy because ratios compared to the competitors' companies, Dole's those stick out more positive. Even after dropping low in 2021 for the stock, yeah, even if it dropped below 11.60, I would sell or keep an eye on the moment. It shows true promising for the market to go back up for them. Their revenue obviously sits very high. They have a high aura around them. They should be a great company. They should never drop again. I mean, I can't say should never, because it will eventually happen to everyone. That's what I got for Dole PLC. This is my final for our project. I had a great time in this class. My name is Dalton, and I'll be looking further into this company as the maturing year comes. Have a good one.